Great. Welcome, everybody. Today, we're going to talk about a few things. We're going to talk about the Chinese economy. We are also going to talk about two companies in particular, Target, as well as Davita Health. We talked about Davita Health a couple episodes ago as it relates to the kind of the state-sanctioned monopoly with air quotes. So we'll talk about those two companies, and but first we'll talk about China. So before we get started, today is August 18th. Again, it is 7 a.m. here in the East Coast of the United States in Hari. 6 a.m. over there, August 18th, 2022. All right, let's get started. Hari, so so we have this title, is China about to take out the world economy? Are you talking about it in a good way or a bad way?
Well, I don't think I don't think it's going to be a good thing for the world. Um, I think we've been somewhat had somewhat better economic news in the last few weeks, and with gas prices coming down a little bit, and things like that. But there's a bubble that's been growing in China for a long time, and unlike the U.S., China has a huge percentage of its net worth based on real estate. That's one of the interesting things about it is that the Chinese market doesn't trust stocks in general, and so they've put most of their wealth into real estate. And what has happened since 2008, when their S&P 500 equivalent kind of peaked, um, is most of the money has been going into buying, homes, buying apartments, and things like that. And so what has happened is it's kind of like the 2008 market here. A lot of money went into buying a place. That money was prepaid, and then the builder would take that money, go use it, highly leverage themselves to go build more places. So they were essentially creating more and more, real estate. And then, it was essentially creating a Ponzi scheme because you're using this to go pay for something else, right? Um, but what ended up happening is the properties weren't getting completed because when the economy started to fall apart, then all of the money that had been loaned out, to pay for this, mortgage, it started unraveling. And then during the pandemic, they also lowered the percentage, which actually happened in 2008. They lowered the percentage that you had to prepay on assets in order to get a loan. So now they've had a run on the bank where people are trying to pull their money out, and the bank has basically told them the state has said you can't withdraw money. So effectively, you're preventing people from. So we're in the midst of what's kind of like a Great Depression style crash that happened in the 1920s in the U.S. and in 2008. Similar type of thing where the bank doesn't have any money because of it's been loaned out. The loans have gone and largely have been spent and don't have anything to show for it. And as a result, there's going to be a huge crash in the Chinese economy. We saw that. I think we talked about it in January about Evergrande, which was like a real estate backed thing. They had like $300 billion in debt, and they started missing interest payments. And then the story just kind of disappeared from the media talking points. But I think we're going to start seeing this slowly bubble up because this is hitting actual, people in China, the working class who have, all these loans that are, now they can't pay back, essentially.
Mm-hmm. I think something that's really interesting. I learned about this weekend when I was listening to some other podcasts about just this particular issue. And if you step back and think about like what is the big deal with the Chinese real estate market? Like why should you and I care about this at all? Because it's happening somewhere in remote country and perhaps in an adversary country, isn't it? Isn't it a good thing? I think I think if you step back and think about the size of this, it kind of blows your mind, right? The equity market, the US equity market, people think that maybe US equity market, the stock market, it's always talked about, right? It's always on the news cycle. Everyone's talking about stock market, this, that. And people think that it's the kind of the world's biggest market, like the NASDAQ or whatever. Wall Street is like the biggest market when it comes to like the stock market. But stock market is not, it's actually smaller than the bond market. So bond market is bigger.
Right.
So there's much more bonds being traded. It's just a bigger market. And then there's a market above that, which is the real estate market. I think it's like 3 times as bigger than the bond market. And then within the real estate market, I think it's about like, I think it's about 300 trillion or something like that. I might be wrong on that statistic, but basically it's much bigger than the bond market. I'm talking about it at a global scale. And if you drill down into that real estate market, I think a sixth of that is the Chinese real estate. And so that's huge. I mean, that's huge. Like 1/6 of the global pie is in a single geographic location under a single jurisdiction. Pretty massive. And what it feels like has happened is kind of what you're talking about, Hari, which is that there was kind of a lax, loose monetary policy when it comes to credit creation, extending credit to folks that might not or should not be having these credits. And now the world, this is where it gets really interesting. The world is raising interest rates. Every central bank is raising interest rates. And when you do that, every credit holder or everybody that got credit now has to, especially if it's like a variable interest rate, now you're sort of screwed because
Yep.
well, shoot, I have to pay more for that loan. And when the entire world is raising interest rate because of the flow of money from one country to another, everybody sort of has to raise interest rate. So you can't be like a lone actor when every central banks are raising interest rate. You can't be the one that's cutting. It's a very dangerous move. But but China right now has done that exactly. And
Mhm.
I think and the reason is because the pain that everyone is feeling in China for the amount of loan that they took out and the variable interest rate, and now the payment they have to make is too high. Like people are writing, not paying their payments on the loan, and so the central bank of China, the People Bank of China, I think they had to go ahead and raise or lower their interest rate so that so that they ease some of this pain. So I think that's a pretty fascinating story. I do wonder about the contagion effect. So again, going back to the question, why should you care? Why do why should us care about this?
Yeah, and I think the thing is that uh, economic crises are always multifactorial, right? The housing crisis that we had in 2008 had multiple pieces, and then you had Lehman Brothers, who was also doing all these credit default swaps and all of this hedging, right? So it wasn't the housing market that crashed alone; it was the banking sector, and then that affects everything else, right? And it didn't just affect the U.S.; it affected the entire world because people had bonds in other countries that were tied to these things, and because they had these complex financial instruments that were the credit default swaps, it caused all kinds of problems, right? As U.S. investors, it's like, oh, that's happening in China, right? But we have banks; those banks have loans out to people in China who are reliably paying that back, who may not be able to pay it back. You have businesses like Tencent announced yesterday for the first time they had negative growth in their public, since they were publicly traded, right? Or maybe their entire history, probably. And so that kind of tells you like what's going on here as a overall as a market, right? the world is one giant marketplace, and when one thing kind of falls apart, it can take out other things in unexpected ways, right? And we could spend 2 weeks just talking about how that could possibly happen, but I think it's better for us to start thinking about, like, we've got inflation here. That's one factor, right? China's economy fails. That's two factors, and then eventually that you have the war in Russia, and China is still hasn't come out of COVID lockdowns, and so you keep adding these things on top of each other, and it's enough to break the camel's back, right? Eventually.
Mm-hmm.
And that means that we have to be prepared to look for cheap businesses that we would be interested in, that may not may get unfairly hit, price drops and things like that.
Yeah.
But let's also, I'll just add one last thing. Let's also not forget, almost everything we buy in the US is made in China, right? And so if they're not able to, function as an economy, right, that means that we can't buy goods from them, right? And then that effectively means it could mean more inflation for us, because we now have to pay more to get the same things because we have to get them elsewhere, right? So
yeah, I think it'll be interesting to see. I think there's a lot of pain in China, clearly, and then there's a lot of pain in Europe, clearly.
Yep.
And then, like Japan is another one that's sort of not doing so well.
Yep.
I mean, all this like macro stuff, like, as us, like investors, that we prefer to not really think about them. We prefer to just look at individual companies. But now what the last 2 years has taught me is that actually you sort of need to pay attention to some of these things. And the way things are going, I feel that, we have to keep an eye out for Europe. I think we have to keep an eye out for Japan and China now. I think these may be patients that might be admitted to the hospital soon.
Yeah,
or
and
not already.
And I would say that it doesn't change how you invest as value investors. Like, we still have to think about the fundamentals of businesses. We have to still think about, what is the worth relative to the distributable free cash flows that a business has. All of those things still apply, right? But it may mean that future pain creates an opportunity for us that we wouldn't otherwise have if we're not paying attention to it, right? Like, for a long time, Alibaba and Tencent and all these stocks were trading cheaply. And now it's a question of, is the economy healthy enough in China for it to continue to be, good business? And I think the answer is yes, because, China will always need Alibaba, right? I think they'll always need Tencent, not as strongly as Alibaba, right? But maybe a lot of these smaller businesses that are still publicly traded could get wiped out, right?
Mm-hmm.
You just have to kind of pay attention to that.
Mm-hmm. Yeah. All right. Let's move on to the next topic. Let's talk about Davita first.
Yeah. So I just want to mention that someone made a comment on our last live stream, asked us to talk about Davita. So if you have any comments or questions for us, we'd really love to hear from you at info@valueinvestor.org. From there, you can get our checklist, which we've talked about in many other podcasts. But you can also ask to join our Slack group, where we talk almost every day about various topics and post news. So we'd love to hear from you, and we'd also really appreciate it if you would comment if we're done with the live stream, comment on this channel on this, and subscribe to the podcast.
Yeah, please do. Davita was one of the things that was mentioned in the comment section on YouTube. So here we go. The Davita. We talked about Davita in a couple of podcasts ago, a couple of episodes ago, as kind of as an example of how when government incentives get into the well-functioning market, it obfuscates the true winner. It sort of puts people on. It sort of picks winners and losers. Corporate welfare. We talked about this in the context of the Anti-Inflation Act, Inflation Reduction Act. and the EV and I mean, by the way, it's hilarious. EV subsidies, $7,500, and then Ford goes ahead and raises the price 8,500.
Yeah, that's how it always works, you know.
It's exactly how it works. So like, again, kind of going back to this, right? Going back to the idea of corporate welfare, and one of the examples that we talked about in the previous episode again is Davita. As a business, it's quite healthy. It's like it's pretty strong. So maybe walk us through what you found, Hari.
Well, I think, in the last year or so, the stock price has come down, I think like 30% or something like that, 35%. And for people who are not familiar with it, because we're not going to go in depth as we would on our normal like 2 episode podcast, but they run a series of clinics that provide dialysis, to patients as an outpatient. And if you're not familiar with how dialysis works, a patient is usually getting dialyzed 2 to 3 times a week. 3 times a week really is what happens because of their kidney function. And for a long time, these clinics were kind of just scattered around, right? There was, your local dialysis clinic here and there. And what Davita did was they kind of went in, and they're not the only player in this space, but they kind of bought all of these clinics, put them all under one roof, and then they got legislation passed that allowed for a stable, protection against, if you lost your insurance or something like that, you would still qualify for Medicare for dialysis. Well, so the Supreme Court ruled, I think recently, I don't know exactly when, and I don't know the specifics of the case, or how this actually created took out the protection for dialysis. But what is in the works now is a separate bill that would actually enshrine that in Medicare protection, so that dialysis is still protected. And what this does is it basically gives Davita a very safe bet that their patients aren't going to the bottom isn't going to fall out, right? And for those who don't kind of understand, like, dialysis is extremely expensive, right? It's like $100,000 a year if you were to pay out of pocket for dialysis. So each one of these clinics is generating millions of dollars in revenue. So because of the uncertainty around the legislation and some concerns about that, the price has come down significantly, and it's trading at, like, as of today, August 18th, at about $90 a share. But Davita is not a growing business anymore. They've pretty much hit their revenue of around $11 billion, and they just kind of, they generate that fairly regularly for the last 3 or 4 years. But what they have done is they've kind of made, we've talked about this on a couple of podcasts, NVR Homes and Southwest Airlines. These are two businesses that had relatively stable growth, but they generated a ton of free cash flow. And because they were trading cheaply relative to that, Davita's PE is about 10. Or I think it may be actually less than that. They're buying back the shares at a huge, clip. And so what ends up happening is there's very limited downside risk as an investor, because they generate a ton of free cash flow. They're able to go buy back their shares, and then their earnings per share is actually growing healthily, because even though their revenue is not. So what I would tell you all is, in my opinion, and I'd love to hear what you have to say, Becco, Davita is just a fantastic business, right? Like, if you were an owner of this business, you would be able to take out all of the cash flow there and go invest in something else, because that you can't really put it back into Davita, into the business itself, right? And the way that this company is returning its money to shareholders is by the share buyback.
Yeah, it's I'll talk about it in a couple different fronts. Davita, I think has been employing this very classic strategy of, it's a very fragmented market, and they went in there and just bought a whole bunch of supply, and now they have negotiating power because they control most of the supplies. They have negotiating power with the payers, and they can demand, XYZ. They can come to the table from a position of strength. I think that's what they've done. In fact, I know for sure that executives of Davita left, or part of them left and started another company in the radiology space. So it's a playbook that a lot of people follow, not just in healthcare. And so they've done that pretty masterfully, right? And they now have a company, since the founding. They now have, since the founding in 1994. And by the way, I think the company suffered quite a bit actually early on. It wasn't able to scale; it was quite difficult. And then these guys came in. Anyway, since 1994, from what I see, to 2020 or 2021, they now have grown the company to be, tremendously profitable. And if you just look at the buyback program, so by the way, just to give you some numbers, just a level set. So it's a company's valued at about 10 billion, so 9.6 billion, and it's generating 11 billion. Okay. And then the cash, and then the free cash flow, stock repurchase 1.6 billion. So they're taking out, let's say it's about a one. They're taking out, at least in the last 3 years, they've been taking out $1 billion worth of their own stocks with their cash. So you're talking about, 1/10 of it going down every year. That's a pretty fantastic way to return value to shareholders. And then another thing is dividend payment. They have zero dividend payment. So I wonder how this ratio, right, zero dividend payment with stock buyback, I wonder how that's going to shift with the excise tax that just got passed.
Yeah.
But overall, it's a very steady business. You're not going to be holding this for like a quick 10 bagger or something like that. I think this just hold, and they will continue to buy back stocks. It's a great cash generating business. Yeah, so I agree with your points, Ari.
Yeah, the last comment I would make is that, they peaked at around 130 during the pandemic, at the height of the pandemic. And one kind of issue that has been kind of hitting healthcare for a while now is staffing shortages and things like that. So one of their competitors, Fresenius, I don't know how to say it, was reported that they're going to have a hard time with labor costs and inflation. I think that's one of the other short-term factors that eventually will work itself out with Davita, that is weighing in on the stock right now. But those are the kind of things that long-term aren't going to hurt you. And if you're buying back 10-15% of the stock every year, your per share earnings is just going to keep going up.
I do wonder though, I now turn my focus to balance sheet just real quick. I do wonder, there is a lot of debt on the company's balance sheet. There's almost 12 billion worth of debt on the balance sheet. I do wonder if it was the buyback was done through debt. I don't know, but
well, I think they do have plenty of free cash flow, so I think it should cover that. As far as the debt, I'd be curious to see, is it actually long-term leases, or is it, because they're probably not owning their clinics, are they just leasing land, as part of that long-term debt? Because they've had it for a long time at this point, going back all the way till a decade, their debt has been around 8 billion. So I'm not entirely sure if there is a, what the fluctuation is, or if it's just based on, I actually, capital leases is independent of that. So they have about 3 billion in capital leases. So I don't know why they have that heavy debt load, and what the interest would be on there, but I do think that they have enough cash flow to also cover any expenses there.
Cool. All right, that's enough of Davita. Let's talk about Target.
Yeah. I think to kind of set the stage, as a similar retailer like to Target as Walmart. Walmart actually reported pretty good earnings the last quarter, Q2, despite warning that there would be some problems. And I think Target just had their quarterly call, and they said that their earnings fell about 90%. They were still profitable for the quarter, but their operating margin was down to 1%, basically, uh, during the quarter. And they said largely because they had a huge excess of inventory. So during the pandemic, people were buying, like, home goods, electronics, things like that. And Target just continued to stock up on that. So they missed their inventory, um, like, read on the, because as people started coming out of pandemic times, they started spending money on services instead, like travel. And then, oil and gas prices went up. And so things kind of shifted in their consumer spending. And so now people are still spending money, but they're not spending it on, physical items that they would buy at Target. They're buying it on, spending it on groceries and things like that. So, it's, I remember about 4 or 5 years ago, Target was in the same boat. People were actually explaining at that time that Target is going to just go away because Amazon is going to just eat its lunch. And meanwhile, I would talk to people and they'd say, well, I don't want to go into Target anymore because every time I do, I spend too much money. And I'm like, well, that doesn't sound like it's a problem for Target, right? So they started doing their, buy online, pick up at the store kind of stuff. And everything kind of just, worked out for them, right? They, Target did really well. They were trading at like $50 a share. Now it's like 180. I think it was peaked much higher than that. So I think the story here with Target is, can they actually fix their inventory problem? Because I've seen this take out many companies, right? Target's pretty big. I don't think it would hit them at that level, but they've got to clear out all of this trash, right? That they can't sell. And then they've got to kind of focus on the things that people are actually looking for now.
It makes me think about a couple companies that we talked about in the past. The inventory, the excess inventory, if you do it wrong, it could really be a company killer. And I think the company doesn't get killed with one cycle of bad inventory, but I think one bad cycle of bad inventory leads to another cycle of bad inventory.
Right.
And then it just cascades down from there. It makes me think about, what's that company? Francesca?
Yep.
They had a bad inventory. Consumers didn't really like it. Whoever the buyer is, the merchandiser of Francesca, didn't really understand the consumer taste, and then had an excess inventory that it didn't really land with consumers. And then from there, excess inventory, now you got to do a big discount, and that's going to hurt the company. And then next cycle, you're sort of always doing, playing catch up at that point.
Well, and Francesca's was a great story of a business that actually had no debt. They were debt free for their entire thing, but still declared bankruptcy because they couldn't meet their lease obligations. Right before the pandemic, I think they went bankrupt because they were just struggling with just simple cash flow, because they had a bunch of inventory that was unsold, and discount, and you've still got to buy new stuff, and it eventually just ate them alive. So, it was a pretty sad story, to be honest with you, because I thought they were a good business, well disciplined in terms of cash flow and management and all of that stuff. But when the consumer disappears, and we always talk about the moat, right? When they had a team of purchasers that were great, that left the company for better prospects or whatever it was, and then they replaced them with people who weren't as capable, and it just completely destroyed that.
Mm-hmm.
And you think about it from the business, like we talk about the CEO, we always talk about the board and the management. Are they properly incentivized? But the purchasing department, there was no, they didn't have a C-suite title, right? And and when you think about it, it's kind of an undiagnosed, like problem, right? That you didn't pay attention to that. You could have easily lost your shirt, right, with a company like Francesca's. I don't think Target is in that. I think Target's a very savvy company, and they'll figure it out. But we should be watching them to see, are they clearing these out, the inventory, and out in the next couple of quarters, and has it recovered by Christmas time, right? I think is what we should be looking at,
Hmm.
because I wouldn't give them more than, if they get it wrong for a couple of quarters, we can forgive that. But if they mess it up for the holiday season, I think it could be big trouble for them.
Do you know what is the buying cycle? Is it do you know, is it like every quarter? I don't know if you looked into it.
I haven't read their annual report in a while, but typically what the retailers are doing is they'll buy for Q2, they're buying things in Q1, right? So they're putting in all of their orders and their bids, and it's usually 2 to 3 months in advance because of shipping times and inventory adjustments and things like that. So Q3, I would expect they've already put in all of the orders for that stuff. And if they hadn't noticed this stuff early in Q2, Q3 would be problematic. But I think now that they know it, I think Q4 is when you should start to see, are they ordering the right things on the, on the right cycle?
Hmm. And it's interesting. How did other companies not have this, like Walmart, for example?
So, it's an interesting thing, because I think Target wasn't the only business like this. TJ Maxx, who is actually, oddly enough, is the discount retailer who gets the overstock, right? They got hit pretty hard with the same problem. They were buying a lot of casual clothes when people are now going back to work and, trying to dress up and, refresh their wardrobe. They had the wrong mix of things. But Walmart, I think, succeeded where Target kind of didn't, in that Walmart has more of the low end, goods. Walmart was warning about inventory problems, but I think they were able to navigate it a little bit better because they have a stronger control of their supply chain. One, and two, I think because they're targeting a lower end, demographic. That population was still buying staples, which is what Walmart is more, known for, right? Target is staples plus additional, quote unquote, luxury items. But I don't have a great answer for it. Like Home Depot also did fairly well, during this time. And I think because people are, repairing their own houses instead of, spending money on, other things. So Home Depot, I think, was able to navigate this better than Target has.
I wonder. I mean, it's a very delicate dance, I feel like, here, and I am obviously not from. I think both you and I are not from this industry, but the inventory management and purchasing upfront and making sure that mix is right seems like a very I mean, it's core to the business as a retailer, and I feel
Right.
like it is a very delicate dance. You have to read the consumer. You have to also look at kind of leading indicators. I mean, there's probably a bunch of science that go into it.
Yep.
Um,
Well, here's one good story if you're looking for a business that navigated this well, is Michaels. So Michaels was the arts and craft retailer. In 2020, like during the middle of the pandemic, or 21, I should say, 2020, they put in a new CEO. He had a heavy focus on talking to the customer, getting the right inventory mix. And what he heard was almost everybody had a positive history with Michaels, but because they started cutting the quality of their products and started had the wrong inventory mix, people just stopped going to the store. And then, after putting in the right people in place, during the pandemic, everybody was at home. They were doing a lot of arts and crafts in their house, got the right mix, and suddenly their sales and free cash flow just started booming. And so, that, like you're saying, that just that getting the right mix of, to get people in the door and make it interesting and want them to shop there, right? Like retail can have a powerful impact on, on people, right? Like if they have a positive, view, like people have a very positive view of Amazon, then they keep shopping at that place, right? And if you have a negative view, then, it slowly just goes out of your mind, and then you stop thinking about that store, right? That's eventually how it fails.
Yeah. It is I suppose that the takeaway for me from all of this is that when you think about Target, when you think about retail stores, you don't really, at least for me, you sort of don't really think about the inventory mix or like what's in the store from a day to day, from a month to month basis. You
Yep.
just think about it as a brand, right? Oh, I'm going to Target or Walmart, and then
Yep.
I don't really know what's in there. I feel like it's sort of commodity anyway. It's just like mix of this, mix of that. It's all the same stuff. But I think what we're realizing here, at least as an outsider looking into this industry, is that the inventory mix, I mean, the subtle changes that we probably consumers as an individual level may notice or may not, maybe sort of not subconsciously notice, but collectively it shows up in numbers. And it's something that I mean, like Francesca and all these companies, like it's very important to get that right. And
Yep.
as investors, I think, I don't know, maybe it's the last question to you. Like, how do you even assess that going into it? Going into like when you look at Francesca or any of these retailers, how do you assess the quality of inventory control they have in place and they have a good track record of it and all these things?
Yeah, I mean, I think one of the best ways to do it, and this is obviously not a scientific way, is to talk to people who shop at those kind of stores or shop at for those kind of things that is sold at that store. So I remember talking to a lot of, because Francesca's targets women, especially the younger demographic, like 15 to like, 35, that, that age group. And when I talked to people in that, what a lot of them said was, I used to love going to that store, but the last few times I went, I didn't find anything. So I stopped going there. Right. And, I think that is a very helpful way to, like, if you're somebody who shops at Target, which I shop at Target relatively frequently, um, I don't notice that because I go there and I get specific things, right? But if you go and talk to people who are, like, you should never rely on your own, sense of what something is. You should go and talk to as many people as you can. And if you start hearing that same kind of, well, I used to go there for everything, but now I started shopping at store X, or I started buying things there, or I started, what you'll find is, because I made the mistake, or and I know a lot of people were like, well, everything's moving online. Everybody's buying on Amazon. So all these brick and mortar stores are just going to die. Right. And then you actually look at the data, and what you see is something completely different, right? Which is those stores are actually doing just fine. And most people that you talk to would, say, I went to Target and I bought a lot of stuff there. So what I would do here is go and start talking to people and saying, if I'm interested in Target, what is your, if you shop there, what do you see? What do you feel? Like, is it missing a lot of stuff? And, the internet is very helpful for this kind of stuff, because if you go onto like message boards and Facebook and things like that, you'll see what people, will say about stuff. And it's not a perfect, example, but it does help, I think another good one I'll leave everyone with was GNC, right? For the longest time, if you needed any sort of health supplement, protein powder, whatever, right? Everybody I knew in early 2000s, they would buy all of that at GNC. And it was because it was the only place that, sold it. They had a large inventory, and they had, a lot of variety. And then in 2015, 2016, I was like, well, GNC, there's now so many different options for buying nutritional supplements. But if you go into the store, you'll see that their prices were also just higher than everybody else. And they were feeding off of a market of just elderly people who didn't know any better and would just walk into GNC to buy stuff. And the stores were empty and nobody I knew actually purchased from them, right? So that, like, this is Phil Fisher, who wrote the book Common Stocks, Uncommon Profits. He called it the scuttlebutt method, right? Which is an old term for, like, what does the man on the street have to say about something like this? And it's a good indicator, but it's not like not perfect, for finding
I
this
would
out.
say, I think that's a great take. I would say that another thing that you can look at the balance sheet too, the build up of inventory
Yep.
and the asset. So if you look at the balance sheet, you'll see inventory as one of the line items. If you see that spike up, or if you see a history of that being very steady, then it's probably a good sign that inventory management has been pretty good. If you see it like spike up or down, that's when you have to look and scrutinize a little bit more. So I would add that as well. Great. I thought I had one more thing, but I lost it. But I think this was good. Good conversation. I see that some of you are watching right now. If you guys want us to talk about a particular company again, just leave us leave a comment on YouTube or wherever you watch this, and or any topic that you want to discuss. I think what we're going to do probably going forward is probably 2 parts, right? It's like part 1, talk about kind of the macro news related, and then part 2, we're going to talk more specifically about companies like we did today. So, all right. Thanks everybody for joining, and I'll see you guys next week.
All right. Thanks.